looking at Elliott wave. We've looked at a pattern which has the 5-3 wave structure, 5 on the upside, 3 on the downside, and within that wave you'll see that same pattern repeating to a lower degree, and within that you'll see that pattern being repeated again. Now that's what theory says. How often do you find this kind of wave structure actually when you're looking at prices, price patterns? Is Elliott wave theory really a reality when you're looking at 3 sets of waves?
If it wasn't a reality, then it really wouldn't have become so widely applied and so interested for a lot of people. But, you spoke about the waves on the upside. Let me show you an example of waves on the downside as well. So this is just to sort of illustrate and reiterate the point that you can have 5-wave structures on the downside as well. So here you have a high, and then you come down. This is wave 1 and 2. Then here is wave number 3. Wave number 4, and this is where right down till here where we go to wave number 5. Now within this you see a lot of squiggles as well, right? Even those are waves, but those are waves of a smaller degree. So 5 sets can be seen, 5 sets of declining waves in this particular case, forming the impulse set. Within that you have the corrective set also. So you have corrective sets and impulse sets. They can be seen fairly often, but you do need to train your eye to see them well.
Right. Well, there has to be a simple way of using these waves for a lay trader to actually use these for setting up a trade. So let's see that, Doc. That's where the money comes in.
Okay, what I have here is something on an intraday basis. I have Axis Bank as one illustrative example. Now I'm showing you this without any wave marking, so you'll have to sort of imagine the waves along with me as I say them. What you have is a decline, right? Now, in this decline, I have this first 1, 2, 3, 4, 5. So that is what sets off the whole series of declines, because once you get 5 waves in one direction, the directionality gets set. So I have this 1, a 2, a 3, a 4, and a 5. Now we come to what we call as a progress level. Now this becomes 1 degree 5, which progresses to only wave 1 of the next higher degree. Then I get another up, which now I classify as being wave 2 of the next higher degree. Typically in the third wave, you will get a lot of price damage. So that is why you got this big, large price gap, and you have these long range bars. So you get a big wave down, which what we shall term as a third wave. And then you have another upward sort of corrective wave, which is the fourth. And all the way down here, you have the fifth. So once you have the initial 5 down, then you know the direction is down, and then you are only waiting for the rest of the waves to sort of emerge. Now, if I take this entire 5 down, I have the next higher degree wave 1. And to that, now I have another A, B, and C, which I shall tag as being the next higher degree wave 2. So, see, the progress label thing is the key. It tells me that I am going from a smaller degree decline, which is your first level of decline, to a next higher degree decline, which means that I'll get 5 waves to the downside. Then I get wave 1 of a still higher degree, which now tells me that Axis Bank should head out even lower. And when I actually look at it, now here is Axis Bank. As it moves lower and lower, it actually goes a little sideways, and it actually is going to break down, because I have wave 1 and wave 2 which ended here. So what I will have now going down from here is a wave 3 of a higher degree, which starts to move out to the downside. Now, this may take a little while, but this is how it happens in real time. You can't sort of hurry it up, or when you see it in retrospect, it all looks very nice. But what you get here is again a smaller degree wave 1. See, 1, 2, 3, 4, and 5. So that's a smaller degree wave 1 which has unfolded here. This is a smaller degree wave 2. Now, the whole thing is happening within the context of a bigger degree wave, which is now in the process of unfolding. The third wave is the one which is always the one with the most amount of damage, which is what we are seeing here. So when you know that the third wave is going to unfold, you know what kind of price move to expect. And you could be positioned with a nice big short here at the end of wave 2, or at the end of wave 2 here, and then you could have probably written this whole thing down. And now this is going to end and complete the third wave. And then we will pull up into a fourth wave. And that fourth wave, if you miss the third wave by any chance, will give you another chance to short for the fifth wave, which will come downward. So knowing wave structure and knowing the kind of waves it will. See, the third has ended here. Now this is the fourth in progress. Now the fourth wave will also set up. and then you will have another sort of decline which will take you into the fifth wave. The thing which we are discussing as being 5 waves down and 3 waves up, or 5 waves up and 3 waves down, is at the most basic and simplistic level. So there are so many more rules which need to be learned, and once you know the rule, then you know which wave is ending, which degree is ending, and when is the next degree going to begin.
So I have some of these rules, and let's look at them. Actually, if you summarize them very quickly, you can see that table coming up on the screen, and I really need a piece of paper to actually go through these for you. Wave 2 cannot fully retrace wave 1. That's very important. Wave 3 can never be the shortest of the three impulses. In fact, as you will see later, and Doc pointed out already on the Axis Bank chart, wave 3 is the one that really is the strongest impulse and gives you a lot of chances to trade. You have wave 4, the bottom of which cannot go below the top of wave 1. So I'll just say that again, wave 4 bottom cannot go below the top of wave 1. And finally, waves 2 and 4 should always alternate in form. Basically, they need to be in opposite directions. Are there some percentage rules, as in wave 2 should be a little bigger than wave 1? How do you analyze it?
See, once you, like I said, once you have accepted the basic premise that has been stated by Elliott, saying that the market moves thus, right? Everything else which follows is logic. Now, let's take the case of wave 1 and wave number 3. Wave 3 is the growth wave of any structure. Now, growth wave, when you say the word growth, it has certainly, it actually conveys some larger size, right? So, therefore, wave 3 has to be necessarily larger than wave 1. So, we actually, even though Elliott didn't do it, subsequent practitioners have taken the Fibonacci sets of ratios and brought it into play along with Elliott wave, saying that a good wave 3 will be at least 1.618 times the size of wave number 1. So like that, for each of the waves we have built in, and we have actually borrowed from the Fib series and said that, okay, wave 2 should be so much retracement, wave 4 should be so much retracement, wave 3 should be so many times of 1, 5 should be so many times of 0 to 3, and etc.
Okay, and I think you can see that on that chart, on that table once again, and basically wave 2 will usually be a deep retracement, more than 50% of wave 1, that's what we were talking about. Wave 4 will usually be one of those three ratios of wave 3. We have three out there, 0.38, 0.5 or 0.618. Once again, the Fib series numbers that Doc was talking about. Wave 5 will usually be 0.618 times the length of wave 1 to wave 3, and ABC corrected waves will retrace to the level of wave 4 of 1 degree lower. So that's what it says. I think it takes a while to digest that, but we have all the time in the world to do that and see if it really works. But corrective waves is where we are right now, Doc. And do you have set patterns for those as well? We're talking about the ABC now.
Yes, the ABC, if you thought that, the impulse was the difficult part, I have news for you, right? Because the entire difficulty comes more in the corrective waves, because there can be so many variants. But the good news is they are all variants of few sets of limited things. So basically you got A, B and C, right? Now you got it in three different varieties. One is an ABC which we call as a flat correction, which I have for you on the chart here. Now if you look at it, this is your downward impulse, right? And once you have a completed downward impulse, you will slip into a correction, right? So in the correction, you got an A, and you got a B, and you got a C. Now the key thing to note here is that the length of wave A, B and C is more or less similar, which means that the whole thing takes on a pattern of something like, let's say, a rectangle, where the tops of A and C are similar, the bottoms of, bottom of 1 and B are same. So the whole thing goes sideways. This is what is known as a flat correction ABC. Now similarly, I have something else called as a zigzag correction. And in the zigzag correction, what you get is a little bit of price damage. And now if you notice that in the, in the ABC flat, you really didn't have much of a price which was damaged. Now here is a zigzag in the upward direction. Now I have the thing which is going down. In the flat, you had everything going sort of net sideways, but in the zigzag, you will have the A and then the B and the C finishing significantly higher than A. So you have price which changes quite a bit. So this sort of an ABC where C is much higher than A, B is much higher than the bottom of the first impulse, this is known as a zigzag correction. So you got most of the time what you will see is flats and flats in zigzag. But there is yet another variant, which is what you will see in some other sets of cases, and that is known as a triangle pattern. The triangle pattern we have studied under our normal technical analysis. That is also accounted for within alien. Now, because it's a corrective set, like I'm showing you here on the thing on my chart, you have here what we see here as the downward impulse, and then the market, instead of showing you the normal ABC and then slipping into the next set of impulse, it shows you two extra corrective waves. Now this becomes a little bit of a complication of your simple correction. So the triangle you could probably say is a little more complex than your normal flat or a zigzag, but this is also considered to be among the normal set of correction. So the triangle is A, B, C, then you have two more waves, which is D and E, but all of them going over the same area. So the whole thing is going to be corrected. So you have three types of them. The flat, where A, B, C lengths are all similar. The zigzag, where A and C lengths are sort of different and C is much, it's much higher than A or much lower than B, depending upon what correction it is. And the ABCDE, which will be a triangle, which is a large, messy kind of sideways move. So these are, I hate to say this, but these are known as the simple corrections.
Right. Well, you have me dumbfounded, Doc, really. I have no words at this point. I think it's best to go into a break.